Welcome to the Transparent FX Academy. In today's video, we'll be speaking about which are the best patterns to trade in the market. Everybody is speaking about candlestick formation patterns, but those are not the best patterns out there. Actually, those are the best ones for hedge funds and banks because they use them to actually hunt your stop loss. But today, we will be speaking about some very high probability patterns that there are in the market that you can use to your advantage from a directional perspective, and then obviously the entry you take it on lower time frames. So I will invite you to check the video until the end because it will be very valuable. If you don't know who I am, I'm a top author on the trading platform as well as running an educational program and swing trading full-time with my students. Okay, so today we will be speaking about W and M formations, very important formations in the market. So you can develop a whole strategy around them and they're very profitable. So let's start by defining why they even form in the first place, because it's a very important explanation on why these patterns form. So let's start by first defining the shape of, for example, an M formation or a W formation. An M formation is something like this, okay? Where the market creates a high, goes a little bit lower, then starts another push to the upside and then creates a lower low, basically failing to create a higher high. And sometimes this push to the upside here will create an equal high, so basically a double top. Other times it will be a little bit lower high and basically melt to the downside. And same thing basically for a W formation. Sometimes this will be at the same low, sometimes this will be a little bit higher. And what happens after an M formation or a W formation? You will see the market make a push back to the neckline with a very high completion rate. And there's a very good opportunity to be looking at possible long positions or short positions on lower time frames if you see these patterns on higher time frames. What do I mean by this? For example, if you see an M formation on the weekly time frame, then on the 4-hour time frame, what you will be looking for? You will be looking for possible buying opportunities for a very good risk to reward, because these moves will be a lot of pips since the pattern that gives you the direction is on the weekly time frame. Same thing for a W formation. But let's speak about the psychology of these patterns. Why do they form in the first place? Well, the answer to this is actually very simple. Why do these patterns form? Let's start by the start, okay? You have an impulse in the market. Then a retracement starts. Now, when most retail traders see an impulse in a correction, what do they immediately want to do? They want to buy, right? Impulse, correction, and impulse. So what do they do as soon as the market starts creating the next impulse to the upside? They immediately buy, okay? And most of them don't even know how to read the market on lower time frames. So they just see the impulse, see the correction, they immediately buy. They don't even care what is going on lower time frames or what we have from a COT perspective. So what hedge funds are doing on those pairs. But anyway, as soon as the market starts to push to the upside, they start buying. Well, that is perfect for hedge funds because, as you know, these guys have a lot of money to manage, okay? Too much in money because there isn't enough liquidity in the market to actually fill in their orders. When we place a trade, we just click the button and our trade is immediately executed. These guys don't have enough liquidity in the market. What does it mean? If they want to buy, there isn't enough people that are actually selling. For every buyer in the market, there needs to be a seller. If there aren't enough sellers, what do they have to do? They have to create them, okay? So they create the sellers. So as soon as they start to buy, what they can do, as soon as retail traders start to buy during this push to the upside, is perfect because they can use their liquidity to actually sell. And that is how the M formations actually form. And the same thing applies for the W formation, right? Push to the downside, the market starts a retracement, then the market starts the next impulse to the downside, everybody starts to sell, and perfect. They have the liquidity to actually buy. And at that point, what do? They buy and the W formation is formed. Now, after this, what what they will do, they will take some of their profits. And that is exactly where there is the possibility, and most of the times, like 80% of the times, this pattern will complete on all time frames to the neckline. And same thing here. Just a quick reminder, make sure you comment below and you let me know which videos or topics you would like me to make or cover in the next video. And this is where the real opportunity is, because here we know that there is a very high probability that the market will actually go to the neckline. Specifically, if when you look at your order flow tables, so what hedge funds are doing on the pair, if you see, and if you don't know what COT database, I made a lot of video. Every time I make an analysis, I speak about it, is the positioning of hedge funds in the market. If you see them during this push to the downside, actually closing out their short positions, then this pattern will complete with a very high completion rate, okay? Very, very high, because if they want to continue to go lower, they would be adding shorts, okay? So anyway, if on the weekly time frame, for example, you have an F formation or W formation, definitely you need to be looking on lower time frames for a possible short or long position. Now, there is another thing, okay, which is called an overextended W formation or overextended M formation. For example, an overextended M formation, when does it form? When the last leg in the market continues lower than this previous point. And this is a huge opportunity. Why is it a huge opportunity? Because you will have a huge risk to reward for all of this retracement back to the neckline, okay, for the completion of the pattern. And speaking about this, there was a very, very good opportunity on GBP CAD at the start of this winter, basically for a huge risk reward to the upside that I've been taking on it. So let's give a live market situation of an overextended M formation. Now, as you can see here, we are on the weekly time frame of GBP CAD. And what did we have? We had the market that had created this very nice overextended M formation with this huge push to the downside. Now, obviously, in all of this push to the downside, you might be asking yourself, how can I know that the push to the upside is supposed to start exactly from here? Well, you don't know, okay? Trading is reactive, not predictive. You have to wait for the market to show you that it's finding a bottom by monitoring price action on lower time frames. If everything on the 4-hour time frame, for example, because always remember, monthly, weekly, and daily are for direction. The 4 hours is for entry. If everything is just pushing to the downside, there is no opportunity to take a long, sorry. But if you see the market start to shift from a bearish market to a bullish market, then you can start looking for a possible long opportunity when you have the rules of your own strategy actually satisfied. You need to have your rules satisfied. You need to have rules. If you don't have rules, then you're not trading, you are gambling, which is a completely different thing. So what basically we were doing here, we were looking for a long position after this M formation, overextended on the weekly time frame. But here we had even more confluence, because on the monthly time frame we had a regular M formation. Okay, so we had a regular M formation on the monthly and an overextended M formation on the weekly. So a lot of confluence for a possible long positions, right? So that was perfect for us. So what did we do? Now on the 4-hour time frame, we took a very huge risk to reward opportunity to the upside, and obviously the upside target, where was it? Let's speak about where the upside target was. Upside target was at the neckline, right? At the neckline of the overextended M formation, as we have seen in the example that I showed you before, right? The target is at the neckline. That is where the pattern actually completes. So when it comes to the entry, obviously I can't share my rules for entry. That is part of the mentorship program. The only thing I can share with you here is that basically we had two things, okay? What did we enter exactly here? First of all, we had this previous resistance now turn support here. Second thing, we had a clear demand zone from a 4-hour perspective, because in all of this very impulsive move to the upside, which was clearly showing that basically hedge funds were buying, plus, I mean, I don't have the data here all that back because I deleted just to keep what I need, but hedge funds were clearly buying in that period the GBP and selling the CAD. And we had a clear demand area here. Why? Because in all of this push to the upside, there is one red candle, meaning that the market reacted to that zone, meaning that when the market will retest it, it will definitely show a reaction to the area. And in fact, what the market did, it did created this huge push to the upside, going all the way to our overall upside target for a huge 1 to 7 risk to reward. So what are you supposed to be taking from this lesson? Number one, weekly M and W formation and also daily M and W formations will give you huge risk to reward opportunities on lower time frames if you know how to find high risk to reward opportunities from a 4-hour perspective, and you need to have clear rules for entry for them. And second of all, you understood how basically psychology works in the market and how basically market makers will manipulate you to basically fill in their orders. If you enjoyed the video, make sure you smash the like button and comment below. It really does support the creation of more free education and analysis for all of you, as well as going and checking out the mentorship program. You find the link in the description. It's a very complete program. You first get all the rules of my strategies and then you trade them live with me. Each and every day you get a new daily market breakdown showing you exactly how to apply the strategies with entry, stop, take profit, as well as having me answering every question that you have each and every day. So we'll invite you to go and check it out or go and check out the next video.